If you knew you couldn't fail, if you knew you could not fail, what business would you seek to own? Now, the reason that that's such an important question is a lot of times people have a preconceived idea that's very limited as to what businesses they can own. They think of larger businesses, for example, as beyond their reach. They think of businesses in which they have no experience as unavailable to them. Before I get into some examples of strategies my students use to buy their first businesses, I'd like to share with you a story of how I bought my very first company and how I was able to sell it for an incredible premium. First company that I bought was a small manufacturing company. It made motorcycle parts. I was a young fella, just a few years out of college. I had no real resources of my own, but I was a bit of a brazen huss. I made it a point to approach the owner and to see if he would have an interest in selling me the company. Well, the company was way over my head in terms of the amount of cash that he wanted for the company. So there was no way I had the money. The seller and I hit it off, and we got to talking a little bit about our backgrounds, and I built with him what I've since come to call a cosmic bond. And this is important because when somebody likes you and then eventually trusts you and respects you, the chances of you putting a deal together are way better than if you're just two strangers talking about stuff. So over the next few months, I tried to figure out how I could come up with the high purchase price. And eventually the seller expressed that he was flexible and that he would settle for a certain amount of the purchase price down. And then the rest could be paid out of the earnings of the business over the next 5 to 7 years. So I was able to get the seller to reduce the amount that he wanted for the company down to about 25% of the purchase price. But that purchase price was so big, and even that 25% was so big that there was no way that I had the money. But I was willing to dig in and do research. And I found out that there are lenders out there that are called asset-based lenders. Now, you all know what an asset-based lender is. Anybody who's ever bought a car, you know that the asset serves as the collateral behind the loan. And so if you don't make the payments, the lender will foreclose on the car, take the car back, and they sell it, they get their money back, and that's an asset-based loan. Okay, so you've already probably done one of these, but you did it personally. Well, I found out that there were asset-based lenders out there that would loan on not just automobiles and trucks and vehicles, but they would loan on all kinds of business assets like machinery and equipment, inventory, accounts receivable. And lo and behold, I found out that once I owned the business, I could borrow enough against those assets that I could, from those assets, cover the cost of the down payment that I had to come up with for the seller. The problem, of course, is I can't borrow against those assets until I'm the owner of the business. And in order to become the owner of the business, I have to come up with the down payment money on my own. Well, did a little more research. And I found out that there are lenders out there that will do what are called swing loans. In other words, they'll loan you the money today. That enables you to get the deal done. Then when the deal is done, from the proceeds of your asset-based loan, you pay off the swing loan. Now, the problem that I had with that is I go to the banker who makes these swing loans, and I'm just a young kid out of school. So I don't have any resources to speak of. I don't have any great income. I don't have anything that warrants this big swing loan that I'd have to get. So the banker basically turned me down. He said, no, sorry, you don't have the credentials for this. So I did a little more research. And then I found out that there's these things called double escrows. So I set it up so it would be basically risk-free to the bank. He had a trust department there at the bank, and he could set up these dual escrows, these simultaneously closing escrows. And so what happened is that the banker would then put the down payment money loaned to me, the swing loan, into one escrow. And when that escrow closes, it goes to the seller, and that makes the business mine. Then in a second escrow, we had the asset-based lenders put up their asset-based loan, where I signed all the papers that went into that escrow as if I were already the owner of the business, so that when escrow one closed and the business became mine, then that enabled the documents that were in the second escrow to be given to the asset-based lender, and their money then went to pay off the swing loan from the first escrow. And so since the banker controlled all those pieces, I no longer had to worry about my credit rating for the bank. So with an asset-based loan, a swing loan connected by a double escrow, I was able to use the assets and the cash flow of the business that I was buying to create the down payment money that I had to give to the seller. Pretty neat, huh? Well, that was close to 50 years ago. And we have expanded these concepts and techniques so much since then. We have over 114 different ways now that you can buy businesses and set up these transactions where you don't need the money upfront yourself. And that's what I'm going to be uncovering for you today, is how these things all come together. We're going to start out a little slower. We're going to cover some basic concepts, but then we're going to dive into some of these great strategies and what they can produce for you. We're going to be covering bizarre financing essentials, and we're also going to be going over case studies to give you an insight as to the way bizarre financing is currently being used to buy some incredible businesses and create incredible wealth for the folks who use these techniques. One of the biggest questions that I get from our essential members is, well, what do I do first? It's like there's this wonderful world of businesses out there that are potentials to be acquired. And where do you start? And of course, we cover that a great deal in the Bizarre Financing program. But we want to cover it here too, because this is where you're starting to ask that question. How do you get started? What do you do first? Well, one of the most important things that you're going to have to do, if you haven't done it already, is to decide what business is right for you. And to do that, you start with the right mindset and the right question. And here's the question. If you knew you couldn't fail, if you knew you could not fail, what business would you seek to own? Now, the reason that that's such an important question is a lot of times people have a preconceived idea that's very limited as to what businesses they can own. They think of larger businesses, for example, as beyond their reach. They think of businesses in which they have no experience as unavailable to them. And that's not the question you should be asking. That's not an entrepreneur's question, okay? The entrepreneur's question is, what do I really want to do? What would I do if I knew I couldn't fail? And what business do I want to own? And I'm going to work out all the issues. So it's a big difference in the approach. And the reason bizarre financing is so important to you is because it's going to give you the know-how and the tools to work out all those issues. So that the question you need to ask is, if you knew you could not fail, what business would you seek to own? And remove from your mind any sense of limitation. Just put it out of your sight, out of your thought process. If you knew you couldn't fail, what would you go into? Now that's important. And once you figure out the answer to that, now you have both a intellectual and an emotional target to go after. And the full range of your capabilities can now start to come to bear to produce for you that thing that you really in your heart want for yourself. Really important concept there. And you want to target a business that's optimal for you, one that draws on and feeds your passion. And so then the question that you're going to want to ask is, what type of business is that? What industry is it in? How big is it? Where is it located? And do I want to start this business or do I want to buy it? Important question. We're going to address that very directly in the next few minutes, actually. And the answers that you come up with there just need to be consistent with your values, your experiences, your core competencies, and your skill sets. And all of these, except values, the values are the values you pretty much have already. But your experiences are going to change, your core competencies are going to improve, and your skill sets are going to improve. And so the business that you want really needs to be compatible, not just with where you are now, but where you're willing to apply yourself forward in these areas so that ultimately they all are in alignment with the business that you choose. It's a growing process. Most successful people plan their work and then work their plan. The rest of us are just winging it and taking what comes along. You can wing it and take what comes along, and you might get really lucky. But the chances are pretty good that you're going to do a whole lot better by planning where you want to go. And your plan should be to buy, not start. Here's why. Small service business and simple product companies can be started from your garage. But you start by wearing all the hats. You got to form an entity. And that means you got to decide, are you going to be a proprietor? Or are you going to form an LLC, limited liability company or corporation? And I want to tell you, you don't want to be a proprietor. That's bad. You want to be operating out of an entity that you form called an LLC or a corporation. And that's good. And the reason that this is bad is as a proprietor, you are personally liable for any debts of your business. It means if anything bad happens, all your personal resources are at risk. Whereas if you form an LLC or a corporation, that protects you because what you have inside the company is exposed, but your personal resources and assets are protected because they're outside of the entity. So if the entity incurs debt or incurs risk, only what you have in the entity is exposed. So you definitely want to look at what kind of entity are you going to form to be in business. And that's true if you're starting. Now, what I'm going to do is as I go through all the hats you're going to have to wear, I'm going to start listing them down here so that as I go through them, I'm going to put them here so you can clearly see what it is. But then you're going to get a sense of the scope of it as you see all the hats you're going to wear start to multiply down the screen. So the next thing you're going to have to worry about is compliance, local, state, and federal taxes and regulations. There are so many levels of taxes. There are so many levels of government authorities that you have to comply with that to start a business today, it's a major undertaking in identifying all of those agencies, all of those taxing authorities, all of those government regulators from OSHA to local ordinances. I mean, it goes on and on and on and on. And it's going to take a major amount of time just for you to wade through and make sure you've covered your bases and that you've got all these areas covered and applied for. Because if you don't, the agency or the authority that you're not complying with literally can put you out of business. You're going to have to be concerned with your purchasing. If you want to sell something, you got to buy something in order to sell something. You got to produce something in order to sell something. And even if it's a service business, you have things that you have to deal with in order to be able to produce the service. So purchasing, research for cost, quality, customer service, it all takes a lot of time up front just so that when you start the business and get it going, you have the stuff you need to sell and it's of the right cost, quality, and that you can then get the customer service from whoever you purchased it from to make sure that it stays deliverable to your customer. Then you got to put your sales hat on. Okay. It means you got to develop your sales materials, your lead generation materials, your presentation, your follow up. All of those things have to be put together in advance so that you can go out and sell your stuff. And then you've got to wear the hat, the sales hat, and go out and do the sales. Because in day one, if you're starting the business, chances are you're not having any employees to do all this stuff. So it's you wearing all the hats. Then once you've sold something, you got to be concerned with the customer service. So that's the next hat you got to put on and make sure that your customer's happy, feels taken care of, and feels valued. And then risk mitigation. Well, you've just plunged into this incredible world where risk is everywhere. Legal risk, economic risk. You got to mitigate all those risks. And a lot of that deals with taking care of the right legal issues and taking care and having the right insurance. All those things have to be addressed. Another hat you got to wear. Okay. Then you got books and record keeping. Okay. You start to do some business. You're purchasing. You got to keep records. You're making sales. You got to keep records. You're engaging in other types of transactions that are creating the environment in which your business is going to operate. Got to keep books and records that address all of these things. You need them for taxes. You need them in order to sell the business someday if you're going to sell it. Got to have books and records. All that you have to do when you get started. Then the time comes when you're going to want to hire a first employee. And now you got this whole host of human resources. That's a new hat you got to put on. And on that hat, you got to handle all the things that are required for hiring and firing. Where do you find these people? How do you attract them to the business? How do you decide how much to pay them? How do you set a criteria for what it is you're looking for a particular position? And then if they're not working out, you got to fire them. And then that exposes you to all kinds of rules and regulations about what you can do to fire people these days. All has to be under your hat that you have to wear when you're doing this yourself. Okay, then you've got to supervise these people that you hired. And then you've got their payroll to worry about. And that brings on a whole new set of regulations because when you hire your first employee, all of a sudden you've got payroll taxes. You've got all kinds of rules as to how you have to engage that employee, what you have to do to supervise that employee. But all of the payroll questions come into being. And even if you hire a payroll service to handle all these complexities of payroll calculation and taxes and withholding and workers' comp and all that stuff, even if you hire somebody to do all that in the way of a payroll service, well, it's going to be very expensive, that first one, because to set you up and handle only one employee is going to be very expensive relative to the cost of that employee. So either you're going to have to do it yourself or bite that bullet of having to pay that higher cost. So all of this stuff is compounding now as you're trying to start this business. It's not a simple thing anymore. You have this great idea to go into business, but now all these things are infringing upon your ability to just go do that thing that you thought you were going into business to do. You've got to deal with the compliance for all these employees as you have them, both state, federal, obviously taxes and regulations. There are sometimes local rules. If you're in a major city like a New York, for example, you got city rules that apply to all this. You got city taxes that apply to all this. So the level of complexity starts to really hone in on you when you're starting a business. And then, of course, you got to handle the planning, the research, the strategizing, the testing of what you've produced or what you're doing to make sure that it's working right. And then reworking those things that aren't working correctly. All this to get the business up and running, and all these different hats. And you got to have them all on your head, all the hats on your head, all simultaneously, all at the same time, because you're doing all these things to get the business up and running. Now, I'm not telling you this to discourage you from starting a business. People do it all the time, and they make mistakes. They wade through this stuff. Some of it works out for them. Some of it doesn't. Some they pay penalties when they didn't do it right, and they survive. Okay, at least to some extent, they survive. So yes, it's possible to start a business, and yes, you can do it. But I just want to give you a sense of the weight of the hats that you're going to be wearing to do it. Now, if that was the only way to go into business was to start it from scratch, then you just have to bite the bullet and do all this stuff. But there's a much better way, and most of you know what it is. And the idea is you're going to buy it. By the way, you can spend 6 months to 2 years in this process paying out more cash than you take in. Now, that's incredible. You'll probably be working 60 to 70 hours per week, and that's going to be sacrificing high quality family time in the process. And the worst part of it is the odds you won't survive 2 years is 67%. That's how many startups fail within the first 2 years. And within the first 5 years, 88% fail. Okay. So you wore all these hats, you did all this thing, you spent all this money, you made all this commitment, you put in all this time, and the failure rates are astronomical. Buying a business turns this model on its head. Number one, you can purchase a good, going, successful company, already done all this stuff, already worked this all out, already making money, already positive cash flow, and you can buy that company using little or none of your own cash. Well, wow, what a big difference that makes. It's incredible. Just that single difference just took all of this stuff away from you, put it all in the plus because now you're thinking buying instead of starting. You cannot wear any of the hats. You can just be a chairperson. You can buy a business that's already of a size it's professionally managed. It's got executives. It's got everything in place already. All you do is buy it. Now you're the chairman and you decide on the major decisions, of course, but you're going to do it in concert with your executive team. But you don't have to wear any of the hats. You can pull cash out of the closing and draw income from day one. That's the beauty of it. Once you learn how to fully leverage these purchases, it's not just buying for little or no cash. If you do it right, you can actually pull cash out of the closing and still have everything positive and still have it working for you. If you're working more than a normal work week, it will be because you love what you're doing. In other words, you're already buying a company that's past that hassle stage where the owner has to do everything. And now you're buying a business that's truly a business, up, running, successful, profitable, that enables you to have the time to put it where you want. And if you're spending the time there, it's because you're passionate about the business, not because, you have to be putting out fires all day long. And then the last item here is the odds are you will survive 2 years is 93% as opposed to 67% that you're going to fail. And that you're still going to be successful in this business in 5 years, the odds are 90% in your favor instead of 88% that you're going to fail. It's a huge difference statistically, emotionally, viscerally, every way you can think of. So buying a business is where you want to be. And the whole idea of bizarre financing is here you have the training where the odds favor you becoming a person of wealth. That's what we're about here, is not just having you survive in a business and have it be this tough process that hopefully someday is going to produce for you all this income you want. The idea is to have the understanding and the tools that can make you successful right out the gate. Now, you can buy businesses of any size. Ironically, a lot of our members in the past have used these wonderful tools that we give them, and they try to buy mom and pop type businesses that employ 6 people or less, where the sales are 250,000 to 750,000. And the earnings to the owner are 25,000 a year to 125,000. Now, if all you want is a job, this is okay. You can direct your arrows here, but we recommend you don't. Okay. You can, but we recommend you don't. We recommend that you take a level up, that you look for what we refer to as an entrepreneur managed business. In other words, you're not going to work in the business. You're going to manage the business. And that means it's already going to have employees of at least 7 to 50. It's going to be doing sales of an absolute minimum of 750,000 a year, but more likely on up to 3 million and maybe more. Its earnings to an owner are going to be at least 75,000 a year, but more likely $300,000 or $400,000 a year. So now you're really buying a business and you're buying one that will start to support you instead of you supporting it. And for those who really undertake our tools and our methods, this is where we recommend that you go to buying that company that's already professionally managed. Employs 51 to 250 people, has sales of 3 million to 25 million, and earnings to the owner are 350,000 a year to 2 million a year. And not only will the businesses be more profitable and pay you more, but they're also going to be worth more. They're going to have a higher valuation. This mom and pop business, its value is going to be around $100,000 to $350,000. The entrepreneur managed business, on the other hand, is going to be worth at least $300,000 and on up to $2 million. And the professionally managed business is going to have a valuation of 2 million to 20 million and maybe even more, depending how large it is. Now, the difference in time and resources that it takes to buy the professionally managed business is not 10 to 20 times what it takes to buy the mom and pop business. It's not. The big difference is the zeros. The same amount of time, almost. You've got more to evaluate, more to look at, it's true. But the time to get the deal done is not a lot more. The tools that you need, you're going to already have them. The understanding and the knowledge of the financing and how to do it, you're going to have those. Your ability to overcome credit ratings and net worth and your own financial statements, all in Bizarre Financing. We teach you how to get through all that stuff. So you want to start targeting at least an entrepreneur managed business. And eventually you're going to want to get to where you're really targeting the professionally managed business, because now you're into real wealth creation. Now, an example of a lifestyle businesses that our members have bought, and these companies have been purchased using their no cash techniques. They can be a lifestyle businesses that are just mom and pop. But to me, a lifestyle business is also a professionally managed business, because you're still at the point where it's all about lifestyle. You're not really creating real wealth yet. It's until that third grouping that you're really starting to create real meaningful wealth. But these are the kind of businesses that our folks have been buying: tax preparation and bookkeeping businesses, catering services, mobile hairdresser services, cleaning services, property maintenance businesses, technology repair services, real estate brokers, website design companies, business consulting companies, courier services, warehouse storage, logo design businesses, online tutoring, IT support companies, marketing services, personal training businesses, food trucks, legal services, a man with a van. One of our graduates actually bought a company. It was called Man with a Van. So I use it because it's a great way to explain that type of business. Gardening businesses. And I'm not just talking about a single gardener. I'm talking about a gardening business where they do commercial type buildings with large amounts of property around them. So these are meaningful businesses, and they run all the gamuts from mom and pop right on up to professionally managed and a whole lot more. I'm just putting this out there to give you an idea of the span of different types of businesses that are out there. But the real question is what does Bizarre Financing empower you to do? First of all, the whole idea of Bizarre Financing is your ability with it to buy successful businesses, any size and any type, using little or none of your own cash, leveraging the business's assets and the cash flow to fully fund the purchase. The mom and pop business doesn't have much in the way of assets, so there isn't much there to finance. The bigger businesses have phenomenal amounts of assets. So the ability to go in and leverage those assets is very, very high. So the businesses are bigger, purchase prices are higher, but the assets are more, the cash flows are more. And the chances of it throwing off enough profit to make the financing easy to pay for is a lot better with the bigger business. So it's part of the reason we not only want you to buy, but we want to help you adjust your target to the larger size of your expectation and maybe beyond your expectation than what you would think of perhaps on your own. And you want to use Bizarre Financing to bring you to where you can develop your purchase into the business of your dreams. That's the whole purpose of being here, not to just have a business you grunt out, but to have a business that really is the place you want to be, doing the work you want to do, being in the place you want to be, enjoying the exercise of your competency and your skill sets and your passion to produce something of value to the world and of value to you. That's where you want to be, and that's where we want to help get you. So what's your mission? Are you just interested in the lifestyle business? Are you interested in creating personal wealth? Maybe you are interested in creating multi-generational wealth. And that's what being in the right business can produce for you. I also want to take your attention off the shiny object called the internet. Everybody thinks, well, I've got to go into the newest thing. I got to go into internet businesses. They're the ones that are growing. Brick and mortar is shrinking. The internet's where the big opportunities are. No, they're not. There are great opportunities there. Great opportunities. But that's not the only place they are. And this chart helps you to see that. This is a percent of retail sales done online, and this is the actual history to date. The forecast is what's being forecast for its growth. But as you can see right now, about 11% of all retail business is done online. Well, that means 89% of all retail business is done through traditional retail. So if you're going into business and you're not looking at traditional retail, you are leaving a big hole in the marketplace. And even by the year 2035, it's still only about 22 to 23% of sales that are projected to be done online. All the rest are still going to be done through the more traditional means. And manufacturing isn't done online. Distribution isn't really done online. You may have a distribution order form on your website, but the distribution is going to be done because you warehouse something somewhere. Okay. So all of your basic, real fundamental businesses are not online businesses. And the reason I'm putting the energy here is because don't allow yourself to be misdirected because of the hype about the internet. The real opportunities are not just there. And in fact, there's so many people looking there for opportunities that it's harder to find now opportunities for online type businesses because that's where everybody's looking. So take your eye off the shiny object. Start to look at the more traditional businesses. You'll find that there's a wealth of opportunity there, much more so than on the internet. Now, here are examples of wealth creation type businesses. Bizarre Financing Essentials techniques enable two orderlies to buy the hospital that they worked for. Obviously, they could not have started in this hospital. It was not possible. But how could they pull it off? Because it had cash flow, because there was a strategy that would enable them to work with doctors and bring them together to make it profitable for them to put up the money to buy the hospital. So you're starting to see where once you're into a going concern, you have so much more to work with. And then when you close the deal, you're so much further ahead and you didn't have to wear all the hats and you don't have to wear all the hats going forward. Bizarre Financing Essentials techniques bought a composting and recycling business. But that isn't the reason the guy wanted to buy the company. He didn't want it because it did composting and recycling. By buying that company, he could now redirect its assets and its resources to take a lot of what was coming in their door and now transform that into a product that he was able to sell into the marketplace that now dwarfs the original company that he bought. So here's the creativity that goes along with Bizarre Financing Essentials. In other words, it's taking what's there and then starting to use your imagination about what kind of company could you buy that even if that's not the exact company you want, how it has the roots and elements in it that enable you to transform it out of its own assets and cash flow into the very business that's the business of your dreams. And so this is one example of how just Essentials, this individual is able to take what he learned there and do this. And here's another one. Bizarre Financing Essentials techniques bought a tractor repair business that grew into a niche farm equipment manufacturer. So here you have these Iowa guys. They didn't have an idea of forming this niche company when they actually started it. But what they did is they bought a tractor repair business. And then as they were repairing tractors in the tractor repair business, they started scratching their head. And they're saying, well, wait a minute, the guys around here need some different types of equipment to do what they do. But you know what we got here in our repair business? We got the welders, we got the presses, we've got all of the cutting tools, we got all of the forming tools, we got everything we need. Well, let's put some pieces together here and see if we can give them a device that'll do what they need to do. And then they did the prototype. They built it right there in their repair shop. And the next thing you know, they're showing it to the neighbors. The neighbors saying, let me try it. Then the next thing you know, they want to know if they can buy one. Then the next thing you know, these guys are building them one or two at a time. And then 3 years later, they got a bigger building and a virtual assembly line, moving these tractors and farm implements down the production line and building them for a very significant marketplace. It all came out of Essentials. It's what enabled them to do this. And everything else they leveraged was leveraged out of the business that they bought for no cash using the techniques in Essentials. You see how that goes, guys? It's an incredible resource that you got there in Essentials because it gives you the grounding to do virtually any type of business purchase and then convert it to whatever it is you wanted to do if it isn't the business already that is what you want to do. Here's another one. Bizarre Financing Essentials techniques bought a plastic recycling business. That's all it was. They just recycled plastic. Okay. But here they had all this raw material. And these were, guys who had kids and they were thinking, and the wives were thinking about what would toys look like, feel like, taste like, touch like if they were green. Green meaning friendly to the environment. And we got all this plastic. It's some of it's being recycled, some of it's not recyclable. And they really dug into all that. And out of that process, they started thinking toys. They started thinking, we got the raw materials, we got forming tools, we got all kinds of things here. We buy a couple of extra pieces of equipment that we didn't have when we first started out. And we buy some molds. And next thing you know, with a little bit of design, they're producing these products. And once they started to sell, the cash flows were there to now grow out that business. So today, the plastics recycling business is virtually for them a thing of the past. They actually sold it off to another party with a contract to take back from them the recyclable plastics that they needed. Now go on with the manufacturing. And they run this business today very highly outsourced, meaning they don't have a lot of employees. They outsource the manufacturing of the actual units. They outsource the resourcing of the plastic to the company that they sold. Got a handful of employees, most of them involved at an administrative level. The husband and wife do the product design. And this is a wonderful, incredible business that came out of that for them. All right, so much for that. I want to take you through some advanced case studies right now so that you start to see, again, how some of these purchases come together and are incredible in the way that value is produced and the way entrepreneurial spirit and entrepreneurial innovation and entrepreneurial know-how can take the rudiments of a business and put them together in a unique way that makes them viable, financeable, and profitable. So here we go. The first case study I'm going to cover with you deals with barter, trading, trading what you've got for what you want, and trading what you want, and don't even have yet, for other stuff that you need or want. Okay. And we're going to start here with two disgruntled cruise line employees. Okay. So here you got two employees work for this big cruise line. I don't remember if one of them was an executive. I don't think so. I think they were managers, department managers in this cruise line. But anyway, they knew the cruise business because they'd been in it for 7 to 10 years each. But they really were fed up with the company they worked for. You know, the company politics. I'm not even going to go through all that because you know all the reasons that employees get disgruntled. Right? All right. So what these guys did is they went out and got control of a rusted secondhand liner. Okay. It was operable. Machinery and equipment was all pretty decent in it, but didn't look too pretty. And they were able to get control of that. It needed this extensive paint job. I mean, really, really bad. They bartered paint for future bookings on the ship. Now, the ship that they had now control over had 500 unfilled rooms in it, worth $1,000 a week if they're used. Virtually all are unsold because the ship wasn't operating right because there's all these unsold rooms. All right. So there's $500,000 worth of buying power per week sitting in these rooms if they can get the ship shape and get it advertised and get bookings and all that stuff, right? So there's 500,000 a week that they can get their hands into, but they got to get the ship up and running in order to do that. So they bartered for advertising with radio and TV stations, magazines, in exchange for future bookings a year later. So they get the advertising time now, and the media and the stations, the magazines, they got the rights to fill these rooms on a cruise that'll happen a year from now. Okay. So meantime, they got advertising that they can use right now. Through the advertising, they brought in deposits, right? Because you're going to go on a cruise. You like the idea. They sell you the idea of a cruise. Okay. So you put up money, right? You put up a deposit. Well, the deposit were enough to complete the painting, repairs, and the upgrades that they needed to get the ship seaworthy and ready for sailing. They gave them enough money to, remember, to hire and break in a crew isn't everything you're going to pay them because you're going to pay them mostly when this cruise is actually happening. But you just have to pay them a little bit because you got to hire them to know that our guys or gals you want to have working for you. And then you got to break them in, give them a little time to know what they need to do and that you know that they know what they need to do. And of course, they had to pay for docking privileges, but all of this was now getting taken care of from the deposits from the advertising that they had. Then the payments, of course, get collected prior to the cruise. So prior to the cruise, they have all the money to pay for the provisioning of the ship with food, fuel, etc., the crew and the entertainer compensation, and everything else was actually plenty of cash left over. Okay, all paid for out of the fact that they had this advertising that brought in the business. They parlayed this barter model into a second and third newer liner, and then they eventually sold it to a major international cruise line for over $100 million. So that is the power of entrepreneurial thinking. Okay. It's looking at the assets that are out there. How can you leverage them into doing what you need to do? Who can you trade what with to give up something that you either don't need or that you can give them at a deferred time when if you have the thing you're trading for first, that lets you get your thing up and going and making money so that when you have to deliver what you traded, it's an easy for you to fulfill your obligations under the trade. So it's moving time and place and assets and making them fungible in your mind so that you know how to adjust these elements in a way that produce the cash up front to be fulfilled later out of the resources that you're creating with the cash you leveraged up front. It's a entrepreneurial process and playing with it, getting good at it and starting to work with it in your head is an important thing to being a really successful entrepreneur. Let me give you a second case study here. This is a publisher takeover and turnaround. And this one here is based on assuming debt, licensing out IP, intellectual property, and creating revenue from licensing and barter. So these are the three elements that are going to come together here. This has to do with a publisher that was losing money. It had over 600,000 subscribers, and it also had a fulfillment obligation that it could not pay for. So in other words, the company was not well managed. They were out of money. They had more issues that they were obligated to deliver, but the advertising revenue was not enough to cover those fulfillment costs. Nobody could put more money into the company. So it was a fire sale. They had to get rid of this company. They didn't know what to do with it. They weren't running it well. And that's what was going on for them. So the buyer gets control by agreeing to assume the fulfillment liability. So the buyer isn't putting up any money. They're just agreeing, look, I'll take over the obligation to deliver out the publications. And in exchange for me doing that, you're going to give me control of the company. So the old owner maintained a minority interest. The major interest now goes to the new buyer, and they don't put up a dime, but they're obligated to cover the future distribution requirements of getting the magazine distributed. All right, so hopefully you got that picture. So what they did is they did an early renewal campaign where they took all the subscribers, all 600,000 of them, and they offered them the ability to renew immediately, even though their renewal wasn't due for another 6 months or even a year, but to do it at a discount. And the discount was substantial enough that a very high percentage of them renewed early. It brought in $4 million, $2 million more than was needed. They licensed out the magazine's library of art and geographical photos. That generated another seven figures per year in licensing revenues. One of its magazines, because it was the publisher on several different magazines, one of its magazines was a hard sell at $10,000 a page, but they realized it was an easy trade. Okay. What that meant was they could trade advertising on those pages at 10,000 per page for airfare, luxury hotel rooms, big screen TVs. So basically they got this stuff in exchange for giving people the right to have their $10,000 page and advertise on it. So they got stuff. They then sold the stuff at 50 cents on the dollar because remember, they're all about generating cash right now. So they converted a $1,000 page cost because now they got to print the ad on that page. In many cases, it's adding a page every time they sell it to the magazine, and it costs them $1,000 a page to add the page and print it and put it into publication. Okay. But they turned that into a $5,000 per page income. Why $5,000 per page? Because it was a $10,000 page that they traded for, but they sold what they traded for as 50 cents on the dollar. So the bottom line is they took something that would cost them out of pocket $1,000 and turned it into $5,000 every time that this publication published its issues. Then they actually did something else with their magazine. Okay, now remember, he owns the magazine, he controls the magazine. The old owner couldn't figure out how to make it profitable. He has money coming out his ears now, but he comes up with another idea for trading and bartering. His company now went out and bought a manufacturer of a single great product, but that product had virtually no sales. I mean, it was just barely selling anything, but it was a great product. Everybody knew it was a great product, but they didn't have marketing money. Okay, so he buys this thing. And the purchase is made 100% on deferred payments. In other words, the old owner was just frustrated, didn't know what to do with it. So they agreed upon a valuation, which was low because it wasn't making money. And the seller took back a note for the vast majority of the purchase because he couldn't do anything with his company. And he'd rather have this guy own money that hopefully he's going to pay than own his company that's going to continue to virtually lose money. So the purchase was made on deferred payments. And he used unsold pages in his magazines to advertise the product that was this great product, generating sales and distribution. So this not well-selling product, this company losing money because it doesn't have sales, all of a sudden goes very quickly from a company that has those issues to a company that has substantial sales and is making a substantial profit. He didn't want to be in the manufacturing business. This was a money play for him. So he basically flipped the company and sold it to a big company, literally for millions in profit because he took a company that had low value because it's not making any money. Through his advertising capabilities, he brought the company to where it's now making substantial amounts of profit and has sales to where it now has substantial value. And he now sells it for that value to the big company. And the big company, of course, has the cash and the wherewithal to pay him cash. So anyway, you get the picture. Okay. This is the kind of thinking that goes into it. Remember, he's not a manufacturer, didn't want to own this company, didn't want to run this company, but he knew he had advertising capabilities that could turn this company into a great company with great sales by just leveraging his advertising capabilities to do that. All right. Buyer assumed the liabilities to the first seller and paid the publisher millions in cash and deferred payments for the increased value. So that's how it was eventually sold off. Okay, next case study, software company, joint venture. This is what we call a build-up buy-in. I may have a little difficulty explaining this to you because it's a little complex. We don't have that much time, but I'll do my best. All right, software company, existing software company, sold expensive, high-priced software that only converted a small percentage of its leads to sales. So in other words, you got this company, they've got this Cadillac, maybe even a Rolls-Royce type software product. They spend money to market it. The marketing brings in hundreds and hundreds and hundreds of leads, but only a handful of leads really are going to be converted into sales because of the high-priced nature of this particular software that they're selling. Okay, so that's the picture. Now, a marketer for them realized that the company was a lead machine for a lower price software solution. In other words, they got all these leads, they're throwing them away. So he realizes that there's lower priced versions of this that are nowhere near the quality of this, but would probably suit a lot of the leads that they're not able to convert. So he went out and found a software company with a product in the low end of the market. The marketer offered to do a joint venture with the expensive software company to use its non-buyer leads to do a build-up buy-in with the low-priced product company. Before I get to that, I might need to explain to you a little bit more about a build-up buy-in. Okay, what a build-up buy-in is, let's say I own a company, okay? And I'm not making a lot of money with it, or I am making a lot of money with it, doesn't matter. I make a certain amount of money, the company's worth a certain amount. I want to sell it at some point. I want to get the highest possible price for it. And the price I want is maybe even higher in my expectation than the company's worth. Whatever the reason is, I own a company, it's doing X and it's worth a certain amount of money. So somebody comes along and offers to do a build-up buy-in with me. And what that is, in this case, would come to me and say, look, I can increase your sales by 200%. Okay. I can do that. And what I want to do is I want to come here and do that for you. And you don't have to pay me anything more than a normal commission to do that. Okay. So when I make the sale, you can take some of the money from the sale and pay me my commission. But if I do that for you, I'm going to make your business twice as valuable, 3 times as valuable, 5 times as valuable as it is now. So I'm not going to just do this for a commission. I'm going to do it if you'll agree to a build-up buy-in. And what a build-up buy-in is that we'll set milestones. And the milestones are right now you do, and I'm going to make these numbers up, 10 million in sales. And you've spent years growing at 7 to 10% per year in sales. I'm going to take your company not to 11 million by the end of the year. I'm going to take it to 13 million by the end of the year. And when I get to 13 million, I'll even pay commissions. But when I hit 13 million, that milestone, I've earned an ownership share in the business of 10%. Now, you just made the company worth 30% more than it was before. So if the seller now grants you back a 10% owner, he owns 90% of a company that is 30% more valuable than the company was if you hadn't done this. So it's almost a no-brainer. He doesn't pay for anything he doesn't get. He pays you your commissions out of the cash flow of the business that you create. And he gives you an ownership that's only a piece of the value of what you've added to his company. So that's your first milestone, 1.3 million, okay? The next milestone might be 15 million of sales, okay? And then you get another 10%. And the next milestone might be 20 million in sales. And that's where you get your next milestone, you get another 10% ownership in the company. The point is, every time you hit a milestone, you get equity in the company. And every time you're getting that equity in the company, the owner's percentage of ownership goes down. They're still in control, right? They still own more than 50%, but they still control it. But their ownership percentage went down, but the value of the remaining percentage they have is always going up and going up substantially. So that's the deal that this marketer made with low price software company. Okay. So that joint venture eventually earned, remember, he did this in conjunction with the owners of the high price software, where they're working together now in a joint venture to do this build up buy-in. So the joint venture, which is the marketer and the owners of the high priced software, that JV, that joint venture earned a 40% stake in the low price software company within 18 months. In other words, those leads were so valuable that the marketer was able to turn that into sales in the low end company at such a rate that within 18 months, they earned through that process a 40% stake in the lower price company. The marketer then sold to the high price software company his share of the JV for 2.7 million in cash and stock in the high price software. So he gets cash and he's now an owner in the high price company. Then the high price software company bought the balance of the low price company for shares and deferred payments that could be made from the low price company's cash flow. Okay. So you see how all of this works now, right? Okay. It's just a matter of know-how. You got to know what you're going to angle for. You got to know what you're trying to accomplish, but the tools are all here. So the marketer ends up as the head of marketing for the combined company and a major shareholder in that combined company, looking forward to an IPO where he and his joint venture partners here are going to come out incredibly well, because they're going to take a company that is a private company that was worth 7 or 8 times earnings and convert it into a public company that's worth at least 12 to 18 times earnings. So the minute that this thing goes IPO, they blow up the value of all of this thing that they just created, and they've got an incredible software company that is ripe for a public offering. Okay. So hopefully you got a sense of the thinking processes that go in here. Now, if you weren't exposed to bizarre financing, I'll guarantee you would never, ever think of anything like this. This stuff would be like Greek entirely to you. And it's the reason why people who aren't exposed to bizarre financing don't see the same opportunities that people who have been exposed here see. It's a different world once you realize that these types of thinking, this type of technique, this type of process exists. And it's only restricted literally by your ingenuity, your imagination, and your knowledge. Next case study. It's called a SPARIC. And SPARIC stands for simultaneous purchasing and raising investor capital. And it means from this business you want to buy, and the same company that you would go to purchase your primary products that you're going to resell is the same company that is likely to want to invest in your business if you present it correctly. Okay. So that's the story here. So the tire store retread, that's our name for it. In this case, two ambitious employees of a tire manufacturer see a small chain of tire stores that are for sale. Okay. They work for the manufacturer. They're managers, one's a sales rep, and they see a small chain of tire stores that are for sale. The chain is located in a region underserved by stores carrying the manufacturer's brand. So in this particular region where this small chain is, the manufacturer has no representation of any tire store in that region selling their tires. The chain, of course, does not carry the manufacturer's brand. So what the employees now do is they will buy the chain and convert it to selling the manufacturer's brand. Okay, now you can see why the manufacturer would love this idea, because now they got distribution into an area that they don't have distribution if these guys can buy that company. So the employees present the tire company with a plan to support their purchase of the chain. The tire manufacturer is asked to loan the employees an amount of money equal to the value of the existing chain's inventory. So what are they going to secure the loan with? The inventory. So the manufacturer, so far, they've got cash. They're not going to take much risk here because their loan is going to be secured by the inventory of the existing chain. And they're going to have the ability to now have that chain sell their tire. All right. The tire manufacturer agrees to loan the employees the amount equal to the wholesale value of the existing chain's inventory. And of course, they take a lien against it. It's a little difficult, but they take a lien against it. And the employees now buy the chain using the manufacturer's loan on inventory, an asset-based lender loan on the equipment. Then they had seller financing payable over 5 years. Between those three resources, they were able to come up with the purchase price. The employees then liquidate existing tire inventory. Okay, now they take over, right? So they liquidate the existing tire inventory at a 20% loss to other dealers to pay back the manufacturer. Okay, now why do they do this? Well, they do it because the whole idea is they're going to become a specialty store for the manufacturer, which is why the manufacturer is so anxious to help them with this transaction. And who are they going to sell the inventory to? Well, there are plenty of dealers in this area that if those dealers can buy the inventory at 20% below wholesale, they'll take it all off their hands tomorrow. They'll all back their trucks right up to their facilities here and have certified checks in their hand, be able to get that inventory at that level of discount because that's all that much more money they make when they sell it. So getting the inventory sold to make room for the new inventory of the manufacturer's tires is now accomplished, and most of the loan is paid back to the manufacturer. The manufacturer ships the new inventory of its brand to the chain on extended terms, okay? Remember, we got a friendly manufacturer here, wants to help this purchase happen, so he gives these guys nice extended terms when they ship them the new inventory. And the manufacturer prices its new inventory to the chain at a deep discount for this first go-around to offset the 20% loss in the sale of the old inventory. So the employees who bought the chain come out whole. All the money is being fronted to them for the entire thing. They've got their inventory of new tires to sell for the new manufacturer. The new manufacturer is as happy as a clam because they now have distribution in an area they didn't have it in before. And they're not out of pocket a dime for all this when everything washes through. They're fully covered. And they just start making money now as the sales start coming in from the chain in the area that formerly didn't have anyone in that area carrying their tires. So the manufacturer gets a no-cost expansion of his distribution. The new owners are fully funded for the purchase of the chain. And that's the way it was done. Okay? Incredible. And that's the way entrepreneurial thinking works. And that's the way bizarre financing techniques get used. So one of the things they all have in common is the proximity to the business of the buyer. Okay? In other words, these people were no different than all the other employees and everybody else that knew or was involved with any of these fields or any of these companies. But the thing that they did have was proximity. But a lot of other people had that proximity too. And the other people who had the proximity didn't see the opportunity and certainly didn't know how to cash in on it or take advantage of it. And in fact, never ever saw it even as an opportunity. So proximity to the business is a key element that helped all of these people, but it wasn't enough. It wasn't enough. Bizarre financing is what opened their eyes to the opportunities. That's the training that they had here is what enabled them to open their eyes to now see things as opportunities that no one else was seeing. No one else knew, even had an inkling how to put them together. Bizarre financing gave them the tools and the know-how to seize the opportunity. That's the keys, folks. the ability to see the opportunities that are around you and have access to the tools and the know-how to seize those opportunities and make them yours. And so the question I'd like you to simply ask yourself, what business do you know well? And are you in the proximity where being close to that business, you can see those things now that nobody else sees because they come up all the time. They're not flukes. This is just all part of life. They're going on all the time. What's your passion? Your passion puts you in the proximity of whatever you're passionate about. And that's where you'll start to see all of your opportunities bloom. All right. So there are elements that once they come together, position you for your future wealth creation. And I've just tried to review them with you so that you have a better understanding of what they are and how they work. Now, I've explained proximity to other people before, and here are some of their comments. Hey, Gordon, you don't understand. I'm not in proximity to any business I could buy. I think you're going to see where it's not true. In reality, everyone is in a proximity to a business that would be right for them. You just don't see it yet. So here we go. I work in the mortgage department of a huge bank. I can't buy a bank. So that was one. Another one was the only thing I love is going fishing. And you buy business out of that, right? And the only thing I do well is party. So what would normally seem to the average human being, these are hopeless cases, right? This is like, where do you go with this? Well, I'm going to show you where you go with this through actual case studies that lend themselves or evolve just from these types of situations. Let's take this first one. The case study is the purchase of a mortgage brokerage business. Okay. The individual, our bizarre grad, worked in the mortgage department at B of A. Okay. Big bank, can't buy a bank. All right. He was in a dead end job. He knew it as a dead end job. He worked for an unappreciative boss. And he, from time to time, got these meager raises that firstly didn't even keep pace with inflation. That's what happens when you work for a big bank. And that's the frustration of the role he was in. Certainly hadn't accumulated any cash to buy anything meaningful. And in his mind, hey, bizarre, I can't go out and buy a bank. All right. So you see the situation, right? Well, here is the magic. Okay. In business, sometimes it's not about what you know. It's not about even where you work. It's not even about the industry that you're in so much as it is about who you know. Okay. It's about who you know. Let that sink in for just a moment, because now I'm going to go someplace with that information. All right. So again, we followed through all of the first bullet points and then adding, he leveraged his contacts at B of A to gain junior partner rank in a mortgage brokerage firm. Okay. Now you should probably say, well, what is that? What do you mean? Well, remember, he worked in the mortgage department at the bank. He knew a lot of the executives there, or at least some of them. And those executives, they worked with mortgage brokers, and they were responsible for identifying certain mortgage brokers and then allocating substantial amounts of credit capacity to those mortgage brokers. So they were in a powerful position at Bank of America, and he knew a couple of these guys. So what he did is he had that contact. He can get their attention. So when he went out on his own to look for a mortgage brokerage business, he was able to identify one where they put value on who he knew at Bank of America, and that who he knew was enough for them to grant him a junior partner rank in that mortgage brokerage firm. Then he used part of commissions on several large transactions that he was now working on as a junior to buy senior partner status. And so now he became one of the important owners of the business. Well, over time, he's able to do a variation number 3, which you may not know what that is yet, but it's a way of using the assets of a business you're a part owner in to use those assets and cash flow to buy out and retire the shares of the other owners of the business. And when you retire the shares of the other owners, you become the only owner, right? The company's buying back its stock. That stock's no longer outstanding. The stock you own is the stock that remains outstanding, and it's the only stock now of the company, and you own it all. So you've used the assets of the business and the cash flow of the business to buy out the other folks. So that is an example of somebody who really worked for a big bank. No way he's going to buy a bank, but he ended up owning a substantial mortgage brokerage business that made him a ton of money and gave him the prestige and the industry and everything else that he was looking for. All right. What about our love to fish guy? Okay. And we're going to talk about a charter fishing fleet, how this individual did that. This individual moved to the Florida Keys. In the process of doing that, he took a job because he liked to fish, right? So he took a job as captain of a charter deep sea fishing boat. Okay. Just an employee, right? Just an employee. Okay. But fortunately for him, he's now the captain of the boat. But the individual who owned the boat also actually owned two boats. But the person who owned this boat that he was the captain of came to the realization that he really just wanted to retire and not operate a charter fishing boat anymore. So our guy proposed to the owner what's called a turnabout partnership. And what that means is I don't have any ownership in the business, but the owner wants to retire. So I make a deal with the owner saying, look, let's do a turnabout partnership. I'll take a little bit of a cut and pay. I don't need all the money I'm making right now. I can live on a little less. And let's let that reduced salary pay for a junior ownership in this business. So now I'm your junior partner and you get the benefit of now having a little more money to spend because you don't have to pay me as much. So that now makes me the junior partner. And then eventually, like a year, 2 or 3 from now, we do what's called a turnabout partnership, where now I become the senior partner, you become the junior partner. I'll use income that I generate in the business to buy out your share. Okay. Now, if you just went to that same owner and they didn't know you, they probably wouldn't go for this. Okay. But they will go for it because you're working for them. They know you're a quality person. They know you know what you're doing. They know you're capable of running the business properly, or in this case, the fishing boat properly. They know you love what you do. All right. And so that was enough to build the rapport and the what we call cosmic bond with the owner, that the owner was now inclined to go along with this turnabout partnership. He got a little benefit up front because he had a little more money to spend because the captain took a little cut and pay. But then at some point, the ownership flips. The individual who's the junior partner becomes the senior partner, and the senior partnership valuation of what the owner owned as their part before is now bought out from the cash flow of the business, from leveraging the assets of the business. However, the buyer is in effect going to do this now, but that gets the old owner out, retired, and it gets them their buyer for the business now. They got their buyer. So that enables them to get out very comfortably. It's called a turnabout partnership. We see these done all the time in business once people know what they are and know how to do them. Now, it goes beyond that. The buyer for the business was able to parlay his one boat into 7 boats over the next 12 years. So how did he do that? Well, the seller got a note payable over 5 years for the balance of the purchase price. So when he became the senior partner and now he's buying out the other partner becomes a junior partner and eventually he's totally bought out. Well, that happens because eventually the seller gets his 5-year note for the value of what he's in effect selling. And the balance of the purchase price is paid by paying down that note over 5 years. Okay, everybody. So we got that? All right. Well, that was the deal, but there was no loan or no lien on the boat. In other words, the business is buying out the seller. The business owns the boat and the business owes the money to the seller, but there's no lien for that note on the boat. This is an important part of this because he goes out and he buys a second boat that's now fully financed by what's called a wraparound lien, using the equity that he now has in the first boat, right? He doesn't own much money on the boat itself. He owns some. There was some loan on it, but not a lot. And he uses the equity that he has in the first boat to meet the loan to equity requirement for the new loan for the second boat. So in other words, when he buys the second boat, normally they would have wanted a down payment, right? A substantial down payment on the boat. Well, he didn't have to have that money because instead of just having the lender get a lien against the boat that he's buying only, and the down payment now protects that lender. Well, what now protects the lender is the wraparound lien against the first boat. So the equity in the first boat plus all the equity in the second boat is what's protecting the lender, so he didn't have to come up with any down payment for the second boat. Okay, so now he repeats that process for new boats as the old loans were paid off or paid down from charter income. And over 7 years, or over a dozen years rather, he ends up owning 7 boats. All right, making a lot of money, doing what he loves, fishing away. Life is wonderful. The third example here is he loved to party and he was good at it. Okay, so how does this come about? Well, he bought a party and event equipment rental company, right? Loves to party, goes to lots of parties, sees a lot of these companies that set up these parties and rent all the equipment and handle all of the event planning, all that stuff, right? They do this stuff. So he got to know some of these people and he realized this is the kind of company he'd like to own because he loves to party. So why not buy a company that's in the kind of party field, right? So he bought a party and event equipment rental company. All right. You've probably gone through people's homes and you've seen these big tents out in the backyard and all of the setup underneath the tent, these galas and festive events that are going to happen, from weddings to just soirees, right? You've seen all that. Well, that's the kind of company it rents all that stuff and everything it takes for the food, everything it takes for the people to eat and dine, everything it takes to set it up for a stage, for entertainment. Everything is handled by this type of party and equipment rental company. So how does he come up with the money? Well, he got an asset-based loan on the equipment, right? So all that equipment that this rental company rents out it all has value, and you're able to get what's called an asset-based loan using that as the collateral for the loan. So that's one source of the money. He knows how to do that, how to double escrow the deal and get money up front in order to actually close the deal. Then he also brought in a college buddy as an investor. Remember, this guy was party king, right? He partied with the biggest and best of them at school. So they all knew him. They knew he was great at the party business. And a couple of them were wealthy kids, came from wealthy families. So he found one of them who said, "Hey, I'd love to be in the party business with you," right? So he came in as an investor for part of the money that was used for the purchase price. And then the seller took back a note for the balance of the purchase price. Okay, so that's how the purchase price got covered. Well, this guy's no sooner operating that business, throwing the best parties in town. Everybody wants him because this guy knows how to throw great parties. He has everybody who's anybody wanting to have him handle the party arrangements for the company. So he eventually parlays his rental business into the ownership of a catering company. So now he not only provides all of the rental stuff, but people want him to do the deal here. So they're happy to have him as the caterer too, because they want him setting this whole thing up, right? All right. And he eventually expands that out into literally a one-stop event production company. And then he parlays that into events produced on his own yacht. All right. So all of that leveraged, all based on his skill set, all based on his love of partying, all based on his capability to throw the best parties on the planet, all tied into the fact that even in school, he had interest in his friends who were wealthy people that he partied with, and they couldn't wait to get behind him to help be part of his party company. Okay. All right. So if you love it, you're probably going to be pretty good at it. And as long as you know how to think entrepreneurially, there's always going to be a way to turn that into business ownership. Now, bizarre financing opened their eyes to the opportunities. Who you know can be enough to get you into business. Just a love of fishing can pay off big. Love to party? Make it your business. These are the lessons here. Bizarre financing gave them the tools and the know-how to seize the opportunity. So ask yourself, what relationships can you leverage? Who do you know? Who can you take who's been part of your life, who has the contacts, access to the resources that you can leverage now into helping you own that company of your dreams? Even what you do for fun can be turned into a successful business. These are great lessons, folks. The world is thriving out there with opportunity. It's just most people are clueless to how they take advantage of them, clueless to even seeing them as opportunities. And hopefully, just this little session that we're having here can open your eyes to those opportunities that are going on all the time around you. Open your eyes to them. Know that you have the tools and the understandings and the information that allow you to think entrepreneurially, and turn those into the opportunities for yourself.
Now, if any of this makes sense to you, what I'd like to encourage you to do is to contact our team, because we have a program where we will literally do all of this for you. So you don't have to think it through on your own. You don't have to go through all the steps and the methods. What we will do is we will actually get it done for you. So if this makes sense, just go to the description below this video and follow the instructions. It'll put you in touch with one of our team members. And from there on, we'll answer your questions, and hopefully we'll work together as partners and we'll get it done for you.